This week we're going to look at a number of markets where we have identified extreme levels. So the first market we're looking at is in the high yield market, and the chart in front of you there, we're just mapping the high yield spreads in the US since 1996. You see spreads down below 400 basis points. They've actually kicked up a little bit, probably 20, 25 basis points in the last few weeks, but nevertheless at very low levels. If we then have a look at where spreads are in relation to default rates, you can see there the chart, the red line now is the S&P speculative grade default rate, and that has been coming down. Now markets clearly run ahead of the actual ratings agency, as you can see in the chart going back to the mid 1990s, but what we can say though is that spreads at these levels would seem to be consistent with the default rate on the right-hand scale of somewhere around about 2%. So 2% tends to be the default rate that occurs during non-recessionary periods, and then as we've seen in recession periods in the US, 10% back in the early 2000s and 10-11% in 2009, 2010. So it's almost a binary situation, either 2% or in no recessions, or 10% in recessionary periods. Now having a look at the probability of recession. Once again, now this time the spreads are in the red, so 400 basis points on the right-hand side, and the blue line here is the US recession indicator, and that's currently sitting at around about 8%. So once again, spreads at these levels are consistent with a default rate of about 2%, and which is also in turn associated with a likelihood of recession in the order of 5%, certainly less than 10% as if we look at this chart going back over time. So yield spreads do appear to be at extreme levels. Certainly they're pricing in a very good outcome in terms of the US economic outlook, and that seems pretty reasonable, but what it does suggest is there's probably little room to go further just at this stage. Next market going to look at is the euro US dollar rate. So the euro has enjoyed a very strong run over the past, particularly last 3 months, but this year. In fact, if you look in the chart there, you can see the euro up around about 117 to the US dollar. So it's at its highest levels in about 2.5 years. On a relative strength index, it's suggesting that it is at overbought levels. So let's just have a quick look at some of the issues surrounding the euro. We should also note that the ECB in their latest policy meeting minutes did talk about the strength in the euro potentially being a concern, having some sort of impact on the recovery that they're seeing today. And it also makes the likelihood of the ECB hitting its 2% inflation target that much more difficult. The minutes also went on to say that the favourable financial conditions could not be taken for granted, meaning that a stronger euro runs counter to some of their other objectives. They also suggest that the rise in the euro is a function of two things. One, the decline in political uncertainty, particularly in the aftermath of the French elections, and also the unwinding of US rate expectations. So let's just have a look at some of those drivers on the euro. The first one, we'll look at policy uncertainty. And once again, so the blue line is the euro, that's on the left-hand scale, and then inverted on the right-hand scale is a measure of economic policy uncertainty. So when it was during sort of 2016, this is around Brexit and also French elections, you see quite a significant spike in that measure, and that sort of coincided with a period of sort of a fairly weak euro, and we can see how that's tracked back time. So it hasn't been a really close correlation, but it has in some sense been associated with some big swings, big moves in the currency. So the fact that policy uncertainty has declined back to levels not seen since say 2015 perhaps might argue for a positive case for the euro. One of the other measures or relationships we should look at is the relative interest rate measures. So in the case of for the euro, we're looking now here at the European 5-year or German 5-year relative to the US 5-year spread. That's the blue line. So that's been coming down over this period. So that is actually, You can see that on the left-hand scale. So it got to be about 2.5% below that of US 5 years back in, well, probably only 6 months ago. So at very low levels, and once again, that was associated with quite a weak euro, as you can see here, down around the one, just over the one level. So the fact that we've seen a slight widening in that spread in recent times, but not a lot. So it's not really consistent with a really ongoing case for a strengthening euro relative to the US dollar just at this point. Now, we should, the other market I want to have a look at, of course, is gold, and we'll just get onto that. Finally, just going to make a few comments on the gold price, which has obviously been lifting in more recent weeks, partly because of the weaker US dollar, but also a perceived increase in geopolitical risk. And so what I'm looking at here is the gold price in today's dollars. So as we sit somewhere around about 1280 or 1290 at the current time. So you can see that there, that's a red line on the left-hand scale. And you can see it historically going back to the late 1960s. The blue line there, we don't have quite the same length for time series, but it's a measure of economic policy uncertainty in the US. So there has been some sort of relationship over time, and I guess the more recent sort of rise in policy uncertainty in the US and uncertainty more generally is certainly supporting gold. But in our view, the big driver of gold is real interest rates. And on the chart in front of us here, we are looking at the relationship between gold and, once again, in today's dollars. So you can have sitting there, the red dot, the most recent observations, and on the Y scale we've got a US core inflation rate. In fact, it's the trimmed mean PCE price index, 12-month change. So that's when it's rising. So in a sense, the chart sort of shows that gold prices has a high gold price has been associated with either very low inflation and possibly deflation risk, as we've seen in recent times down here. So high gold price, very low inflation rates. And then at the other extreme, we've seen very high inflation rates around the sort of 7 to 9% rate, and gold pushing upwards to very extreme levels. So it's that sort of tail risk of high inflation or deflation risk, which has really been the main factor associated with the massive rises in gold price over time. This might be also shown in this particular chart, which just looks at more simplistically the 2-year real rate is the blue line. So more recently, that's on the right-hand scale, and that's inverted. So that's a declining real rate as we go higher in the blue line. And you can see gold price up at those very high levels in 2011. So real rates got to about -2% in the US, have subsequently started to rise, and that's been probably a bit of a headwind for the US dollar, for the gold price. And then if we go back to the late 70s, early 80s, although rates were high, inflation was even higher, surprise to the upside. So that was a surprise inflation-induced decline in real rates during that period. So for us, geopolitical uncertainty is certainly a factor that could lead to further interest in gold, but probably the key driver is got to be what happens to real rates. And at the moment, there seems to be a very modest increase in real rates, which does provide us a modest headwind to gold prices at the